It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian bonds fall, extending the selling pressure seen in treasuries. That's also supporting the dollar. Equities in the region mixed after a flat day on Wall Street. Also ahead, President Biden says he'll hold additional shipments of offensive weapons to Israel if it proceeds with a ground invasion of Rafah.
And I'm Yvonne Mann, live from the Capital Markets Forum here in Hong Kong, where the city's stock exchange is trying to attract more Saudi money here in the city. We're here exclusively from the HKEX CEO, Bonnie Chan, and later we're joined live by the CEO of one of the city's biggest ETF providers, CSOP.
And we're certainly looking forward to those conversations, Vaughn. Let's take you to markets first, where Avril Hong is on top of developments. Avril, stocks lackluster, bonds getting sold off, investors pretty much adopting a wait-and-see attitude.
Yeah, there is a lot to rake through today, so bear with me. As we saw that setup from Wall Street, it was a pretty flat close. And today, Asian stocks are mostly lower, save for Japan and China, for different reasons. In China, we're seeing tech and property rebounding. Property as Hangzhou scraps those home buying restrictions, and the idea here that other Tier 2 cities will follow suit. That's also boosting the commodity iron ore, those prices ticking higher there. In Japan, we have the likes of Oryx after its earnings release. We also got the news about the share buyback. So those are among the stocks, individual names that are lifting the Japanese benchmark. But we're also seeing the sell-off in bonds after a tepid 10-year Treasury auction, and the yields in Australia as well as New Zealand. You're seeing big moves, about 6-7 basis points. And don't forget, we also have a 30-year auction in the US to get through later today. We're also keeping an eye on dollar yen. It dipped below 155.5 earlier, but it's now weakening again after that, digesting of what we got from the BOJ summary of opinions. But let's flip the board, because there's a lot to rake through as well when it comes to developments out of Japan. As we heard from the BOJ chief in the past hour or so, speaking in Parliament, talking about the need to raise rates if the price trends upwards as expected. And this is coming just shortly after the summary of opinions show there was a lot of discussion about rate hikes. And this is against the backdrop, for context, of the recent meeting between Ueda and Kishida, seemingly giving the green light to monetary policy to help cap the weakness in the Japanese currency. So all in, it looks like that meeting in June is a live one, and you can see why the bonds today in Japan coming under pressure. Of course, part of the global picture. Don't forget also, we have another tricky 30-year auction to get through tomorrow, Has.
Well, that's right. And of course, yen traders on edge right now. Avril Hong, thank you so much for that. We have breaking news, a line on Country Garden. It says that it can't make that interest payments on the yuan bond. Of course, Country Garden seeking assistance on that. And now it's saying that Country Garden saying that it can't make interest payments on that yuan bond. We'll keep you posted on further developments. Let's get you back to markets, bring in our first guest who expects the dollar to remain strong and U.S. Treasury yields to be range-bound. Charlie Jamieson is CIO of Jamieson Coote Bonds, a privately owned high-grade bond manager, and he joins us from Melbourne. Charlie, good to have you with us. Your assumptions on what the Fed might be doing, because right now it does seem like traders are in a pretty much quagmire, undecided what the Fed's going to do.
Yeah, look, the Fed have kind of stated that they want to be data dependent, which is quite unusual. Normally, they would have some strategy for this part of the cycle. As they would see growth start to slow, they might look to start to move to rate cuts. But given the weakness of their own modelling through the COVID period, they've become very data dependent, and that's leading them to not do a whole lot. Clearly, this rise that we've seen in some pricing pressures, we have CPI next week to take another look at that, is pushing out any expectation that rate cuts might come. What is interesting, though, is the Fed had the chance to acknowledge that last week and they didn't. That's really put some floor under US Treasury yields for now, combined with a larger than expected curtailing of the QT program. And so we've seen yields just come back into the middle of this range. They're around 4.5%. It's hard to see them moving more than, say, 20 basis points away from that right now until we get more certainty on the price picture or the growth picture, which has certainly been slowing in the United States of late. It's not quite as exceptional as it was previously. Still very good, but not as good as it was.
So, Charlie, how is your portfolio looking right now? Have you made any changes of late?
Look, we still favour certainly European rates. We've got the Bank of England tonight. The UK look likely to be setting up for a rate cut. We saw the Riksbank cut rates yesterday. We still think that Canada and New Zealand can cut rates in the nearer term. The US not so much. So we certainly have a favouring in our global portfolios to be underweight treasuries to some degree versus those markets that are going to see more active central bank movement. But none of these central banks can get very far without the Fed participating. They are at risk of devaluing their own currencies if they let those interest rate differentials get too far. We're seeing Japan really struggle with that concept right now, where this kind of perpetual weakness in the yen is causing issue. So, you know, we do have a favour for those markets that are certainly a little bit further into their restrictive rate settings. They've had higher transmission mechanisms, and we're seeing that bite through their own macro domestic data, whereas the US has been really exceptional and certainly would be towards the back of that pack for anybody that might be looking for rate cuts later this year or certainly into 25.
Charlie, just hang tight. We have trade numbers out of China that we've been waiting for, and we have April exports in USD terms rising 1.5% year on year versus estimates of 1.3%, so better than expected. April imports in USD terms rising 8.4% year on year. The estimate was for 4.7%. So again, both a beat. And of course, exports in particular have been surging, which has been a cause of concern for US and European business leaders as well as politicians. Remember, they've been talking about overcapacity, bearing in mind as well the yuan and the lack of inflation in China, prompting pretty much overseas sales at the expense of perhaps other exporting nations. Again, those April exports and import numbers coming in better than expected. Charlie, just an overview and your thoughts on how China's economy is doing and how you might view its assets.
Yeah, certainly things have been getting better there of late. We've noted that activity has been picking up, and certainly after some concern earlier in the year, these numbers are looking better, which is a good news story, no doubt. Certainly as we sit here in Australia, we're very heavily predicated to those outcomes, and so it's great to see China starting to stand on its own 2 feet a little better. And that kind of points to just the change in step function as we go around the globe. Certainly after central banks and economies seem to move in unison as we came out of the COVID experience, we're now seeing that economies are running at different cadences and then different rhythms. Certainly China has been in the doldrums but is picking up. As I said earlier, we've noted the US just starting to slow down. Europe, which has been on the back foot, starting to step forward a little bit. So it's very interesting as we think to our global portfolios that there are now these divergences that are occurring, and there's actually quite a bit more to look at as we think about our relativities with asset allocation amongst those geographies.
Charlie, we talk about yields and how attractive they're looking. They've not been this high for a very long time. Do you keep chasing yields? What's the right strategy?
Well, yields are high, there's no question, but cash rates are also very high, so they're all in combination. But certainly, it's brought fixed income to be a very investable asset class again, where we couldn't really make those arguments at the depths of COVID. It had portfolio need and want for liquidity and negative correlation at times. Under the higher inflation environment, those correlations have moved more positive. So the change in inflation over the balance of this year will be absolutely critical. As we've noted, they've just picked up a little bit. They're certainly not high like they were in, say, 22, but they're just not finishing off on that last mile that central bankers want to see. So we do think that the yield story is certainly very encouraging for investors. It's allowing them to build up defensive allocations in their portfolios that they may have avoided for quite some time. And certainly the broad expectation is that the next major moves from central banks, as we saw last night from the Riksbank, will be interest rate cuts.
Right.
Now, we feel that that will be pretty mild, so there's nothing huge in that space, but certainly it's a positive development for fixed income.
Charlie, thank you so much for that. Charlie Jameson, CIO of Jameson Coote Bonds there. Just to recap the China trade data that came in just earlier, exports year on year coming in higher by 1.5%. Estimates were for 1.3%. Imports coming in way better than expected, jumping 8.4% versus 4.7% in terms of estimates, perhaps suggesting an economy that is indeed recovering. Bear in mind that the yuan has been pretty lackluster, pretty weak. Inflation or lack thereof in China helping to boost those exports as well. Now, still ahead, we're live at the Capital Markets Forum in Hong Kong. Hear why the new CEO of the stock exchange is bullish about their IPO pipeline. That exclusive conversation coming right up. Keep it here with us. This is Bloomberg. Just recapping some of the lines we're getting from Country Garden, it's saying that it can't make that interest payments on its yuan bond. It has said that it's not making that interest payment guaranteed bond in what may be the first of its case. Of course, this on the back of China's Hangzhou city removing all restrictions. We know that a lot of Chinese cities have been easing home buying policies to boost sales, to prop up the sector. Let's get more from our very own David Inglis. Dave, put all of this in perspective for us.
Yeah, so this is important because it's a test case, Haz, for, if you remember back in 2022, there was a program to, well, effectively the aim of the program back then was to allow some of these developers that were effectively shut out of the capital market to issue bonds, and for investors to then look at those bonds as something as state-backed to some extent. Now, this was back in 2022. Now, some of those bonds, and this is the first test case of that, because there were two interest payments due today on yuan bonds, right? So we're looking at about, I'm giving you the rounded up figure here, 66 million renminbi over two coupon payments, 9.1 million. So that interest payment is actually due today. Now, we did some reporting, of course, in Bloomberg yesterday that Country Garden was seeking help from that program we just mentioned earlier on to pay the interest, because we now understand, based on these lines coming through, that they can't make those payments, right? So we'll try and get to the bottom of this. That's what we know so far. We have until the end of the day, just to put that into context for us. But again, it's a test case for a program that was put in place to backstop confidence at this point in time. We've yet to wait and see. That's the market story of the property story today. The other bit, this is a fundamental story, more in Hangzhou, and you mentioned this. So Hangzhou was the latest major Chinese city to come out and losing their property restrictions and home purchase restrictions in a bid to boost the property market. And we've come in from a lot of cities, so we've here on your screens, Hangzhou, Changsha, Chengdu. Recently, I think this week, Shenzhen also came out with something similar. In the case of Hangzhou, and I'll read you, well, the statement's in Mandarin, so let me just rephrase that here, that Hangzhou City has removed all restrictions on residential purchases effective on Thursday. The city will also strengthen credit support for the property sector, including lower mortgage payments for some home buyers. Hangzhou will no longer review the qualifications of home buyers in what is the latest step, in what is the latest city to come out and help boost, of course, this fundamental story that, of course, when you talk about this in the context of markets, it's a story, of course, that we will continue to follow, because that story remains, of course, as a structural issue for many long-only investors. Has.
That's right. All the moves pretty much lifted sentiment somewhat, but still the benchmark for the property sector down about 50% year to date. David Inglis, thank you so much for that. Let's stay with Hong Kong. Hong Kong Exchange CEO Bonnie Chan says she's anticipating the comeback of big-ticket IPOs to the city. She spoke to Bloomberg as the exchange hosts the Capital Markets Forum in partnership with Saudi Tadawul. Our China Show co-anchor Yvonne Mann is at the event and joins us now for more. Vaughn, some of the headlines coming out of that interview you did.
Yeah, she was very optimistic. And in fact, Bonnie Chan, the Hong Kong Exchange CEO, is right behind me in a panel right now, talking a little bit more about the collaboration that she sees with, of course, the Middle East. But first and foremost, this is a time when Hong Kong needs those new listings, and they need more investors. And in particular, when it comes to what happened just 2 weeks ago, when we heard from the CSRC, the Chinese regulator, initiating some of these support measures for the IPO market and basically encouraging industry leading names to list here in Hong Kong. She says it brings her a lot of hope, and they've gotten a lot of calls and inquiries, and still she mentioned about 100 applications on the IPO pipeline so far. Here's more from our conversation with Bonnie Chan.
I think what we want to focus on at HKEX is really, first of all, to play to our China strength, really build on it. I think that's our trump card, definitely. And then surrounding it, really 3 strategic imperatives that we are very focused on. The first one being our efforts to continue building the market vibrancy and to create that network effect. What that entails is really to bring more issuers, more investors, and more products into the ecosystem.
You mentioned about that. What your predecessor, Nicholas Aguzin, talked about this great IPO pipeline that was coming.
Yes.
When do you think this will finally materialize?
Yeah, I think, well, first of all, as you probably know, only a few weeks ago, on the 19th of April, the CSRC issued 5 measures, which will provide a lot of support to our capital markets, 3 of which are very closely related to the Stock Connect, including a relaxation of the ETF eligibility standards, inclusion of REITs into the Connect franchise, as well as the southbound RMB counter inclusion into the Stock Connect. Also, there is a very exciting one, which is the 5th one, which is to bring high quality, top-notch companies from the mainland to come and list in our market. I think all that is creating a lot of excitement. And I will share with you that actually since the announcement of those 5 measures, we have received so many calls, you wouldn't believe, from potential issuers really wanting to explore doing an IPO in our market. So that's going to add onto the already quite robust pipeline.
Okay.
Now, in terms of when
any IPOs been lined up since those measures come through?
Well, we have the 100 companies or applicants in the pipeline already. And I think with the latest measure and really that excitement and a lot of proactiveness in terms of reaching out to us, I can really only see that building up. So for us, obviously we need the market conditions to also be a lot more conducive to getting the IPOs done. But I think what we've seen lately, especially the last 2 weeks of April, is giving us a lot of hope.
Yeah. When they mentioned the Beijing that they will support leading industry names, what is your interpretation of that? Are we going to get these blockbuster names coming back here in the city?
So my interpretation, first of all, in terms of sector, what we can do really to complement the domestic exchanges in the mainland is to focus on the new economy. That's what we have done very well since 2018. And as you know, we have issued a new chapter in our listing rules, Chapter 18C, which focused on what we call specialist technology. And these are really the sectors I think investors are most interested in at this juncture, including things like artificial intelligence, new energy, new materials, quantum computing. And so while I really want to sort of see more names coming, and I don't know whether they are only confined to this space, I have a feeling that a lot of them will be in the specialist technology space.
The big question is, do those mega names include the likes of Ant Financial, Didi, even Saudi Aramco seeking that second listing, possibly choosing Hong Kong as a destination? Those are all, of course, questions that we asked. She didn't want to put too much in terms of individual names, but certainly there's been a lot of what she calls matchmaking going on here at the Capital Markets Forum. We've seen this warming of ties between China as well as the Middle East, and in particular, they're really wanting to get more, Saudi investors back into this market to potentially replace what the U.S. and European investors have basically shied away from this market due to geopolitical tensions and the like. So how do you get access, right? Well, CSOP, they have one Saudi ETF that launched back in November. We're going to be speaking to the CEO of the asset manager, Ding Shen, in just a couple of minutes to tell her about how things are going with that ETF and what other opportunities are in store when it comes to these Saudi markets.
That's right. Yvonne Mann will be right back. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. President Biden says he will hold additional shipments of offensive weapons to Israel if it goes ahead with a ground invasion of Rafah. He told CNN that the potential loss of civilian life is, quote, just wrong.
I made it clear that if they go into Rafah, they haven't gone into Rafah yet. If they go into Rafah, I'm not supplying the weapons that have been used historically to deal with Rafah, to deal with the cities, to deal with that problem. We're going to continue to make sure Israel is secure in terms of Iron Dome and their ability to respond to attacks like came out of the Middle East recently.
Our senior editor, Bill Ferris, joins us now with more. Bill, what's the latest?
Well, as you just heard, President Biden in the U.S. holding up some of these weapon shipments, not all of them, but weapons that Israel has sought and wanted to get for a while. This is a package of almost 3,500 bombs of different sizes. It is definitely a warning shot to the Israelis and a breach in the relationship that could widen if, as the president warned, if Israel goes on with this ground offensive. I think it's also an attempt to try to put a little more pressure on negotiators who are meeting in Cairo this week to try to get a breakthrough. We saw the two sides come fairly close together last week. Hamas making some changes to a draft and Israel rejecting that. So there is an attempt to try to see if they can cross that last hurdle and get a ceasefire in place, even if it's a temporary one, to allow some humanitarian aid and exchange of hostages or prisoners.
The thing is, Biden himself is under a lot of pressure. Republican leaders are now pressurizing him to perhaps speed up aid to Israel.
That's right. The U.S. Congress and President Biden just passed this $4 billion in extra military aid for Israel. That's not part of what's being held up now, but there is a risk that more aid will be held up. And politically, it's always very difficult. It's going to be very difficult for President Biden to continue to distance himself from the U.S.-Israel relationship. So it's a kind of a matter of time to see how much pressure the White House is willing to sustain and how much the Israeli government is willing to sustain. All
right, Bill, thanks so much for that. Senior editor Bill Ferris. Well, let's take a look at markets right now. China property pretty much in play on the back of Country Garden. Its onshore unit saying it cannot make interest payment of a 3.95% state guaranteed bond by an initial deadline of May 9th, and that's according to a filing. The company will make every effort to fully repay the interest within the grace period. The guarantor will fulfill duty if payment is not made within that grace period. Take a look where we are in terms of those property plays. Agile property up by more than 9% right now. Logan also is surging. Sunak, China Vanka in positive territory. On the back of that as well, we have China's Hangzhou City removing all restrictions. Coming up, we head back to the Capital Markets Forum in Hong Kong for an exclusive interview with CSOP Asset Management CEO. More on that later this hour. This is Bloomberg. Welcome back. You're watching Bloomberg Markets Asia. Let's do a check-in on China markets, how they're faring on the back of that trade data, which we got. Avril Hong on top of that in April, those export numbers showing perhaps a recovery.
Yeah, exports, but perhaps more importantly, those import numbers that were much better than expected, seemingly showing that demand is coming back in China. Finally, we're seeing a bit of that rebound potentially, and that is giving investors something to cheer about as markets on the mainland just about head to the lunch break. We saw, following the data, the Chinese stocks extending gains. We're seeing the dollar China also pulling closer towards the 722 level. And this is on the day when there's a lot to digest on the property front. Let's flip the board and take a closer look at what we're seeing out of Hong Kong stocks as well. We're seeing the Chinese tech names doing quite well today. We did get an upgrade for the likes of Meituan on the price target from Citi, but that reminder, I think, coming through from Country Garden about how these distressed developers are still struggling. It says it won't make that interest payment on that state-guaranteed yuan bond. Just another reminder of the real estate woes on a day where investors are also digesting Hangzhou, that top-tier city, scrapping home buying curbs. So we're seeing also the Chinese developers, the gauge of them in Hong Kong, extending gains today. But flip the board because, as you know, Haas, we've seen the real estate troubles and the status of Hong Kong as a financial hub among the challenges for the stock market there. Indeed, amid all this, Hong Kong has been trying to attract more fund flows, and to much fanfare, we did see that Saudi ETF debut back in November. But since then, worth highlighting how volumes have actually been coming down, something we're keeping an eye on, Haas.
That's right. Let's dig deeper. Avril Hong, let's go back to Yvonne at the Capital Markets Forum, Hong Kong. She's with our next guest. Yvonne, take it away.
That's right, and it is, of course, the issuer of that ETF that Avril just talked about, the CSOP asset management CEO, Ding Chen, joins us now here at the Hong Kong Exchange. Ding Chen, it's always great to have you in the program. You talked about the Saudi ETF a few months ago. It was the rising star. How are things looking here right now in terms of the cross-listing with the mainland? I'm going to get straight to it. What's the latest?
Okay, thank you. Thank you to have me here. Last quarter we launched the Saudi ETF, Hong Kong Stock Exchange. We draw a lot of attention globally because it's the largest Saudi ETF globally. We raised about $1 billion, and since then the market performed very well, goes up about 10%. And we constantly see cash inflow into these products. And as you said, we already apply to cross-listing this product to mainland China. And very surprisingly, in mainland China, a lot of market participants try to participate in this cross-listing. So we will have, both Shanghai and Shenzhen Stock Exchange to list in this cross-listing, the feeder funds of this specific products.
You currently have two applications looking to cross-list your Saudi ETF in mainland China. I think Huatai Pinebridge Asset Management, they submitted their application. There hasn't been that much movement though. But I look at one of your Singapore products like SQQSP, and that was approved by CSRC within a few weeks.
Yeah.
What are some of the main factors, do you think, behind why this approval process is delayed?
So this process take a little bit longer time. I think it's because on the one side is because there's after we hand in the application, there's a big holidays of China, New Year, Lunar New Year, and also there's another partners. Actually, it's our headquarters. China Southern Fund is also try to get into the game, and China Southern Fund, with Shenzhen Stock Exchange also apply for the application. So my best guess is we will have like the two feeder funds will listing the same day on two stock exchange. So that takes a little bit time.
Okay.
But so far from the regulator, the feedbacks are all very positive. Yeah, we don't have major issues on doing that.
I think you've talked about maybe the second half. We might see this finally launch.
Yeah, there will be a second half because for mainland China, after the ETF was approved, they probably needs to another month to prepare for the listing. Yeah.
Now, we talked a little bit more about the inception of the Saudi ETF. I mean, you said it's been doing well. Volumes, though, have come down a bit since its inception. What are some ways that CSOP can do to really pump liquidity into this ETF, and there may be more money and more funds in.
Yeah, exactly. So I think for that part, we need to, to do more client education, to raise more voice about these investment opportunities. So for us, definitely we try to do it. And also we want to, borrow the opportunity, launching the feeder funds in mainland China to raise awareness about these investment opportunities, at least regionally. Yeah. Hopefully we can bring more flows in there.
You've been telling me about your travel plans, and it's been quite busy, Ding Chen, and it seems like you've been traveling a lot to the Middle East. What's next then? What are your plans in the Middle East now?
So I think Middle East market is a very interesting market. The capital market is growing very fast, but a lot of things are still very green, I would say. For instance, like Saudi, the ETF, they only have like 9 ETFs over there. Total size is around like 150 million US dollar. That's small, but we see huge potentials over there. And last year we bring Saudi ETF Hong Kong Stock Exchange, maybe later in Shanghai and Shenzhen. And also we try to be like a bridge, two-way traffic. We also like to bring investment opportunities, Hong Kong and China, to Middle East investors. So we do a lot of work on groundwork to do that. Yeah, find partners. Yeah.
Are you planning to have ETFs purely focused on just Saudi right now, or are you looking at other Gulf countries as well? Because Hong Kong exchanges, they've been flirting with Abu Dhabi, Qatar, Dubai as well, exchanges. Any potential for those markets?
Yeah, we are also, doing research and talking with the local partners, try to look at the opportunities from those markets as well. And also a lot of their local institutions come to approach to us, try to have like a sort of collaborations with us as well. Yeah.
There's been reports that the CSOP ETF it's been really backed by one big name, which is the Sovereign Wealth Fund of Saudi Arabia, PIF. Are you talking to other big Gulf sovereign wealth funds out there, whether it's Mubadala in Abu Dhabi or QIA in Qatar?
Yeah, we obviously, for those names, we already have a relationship with them. We talk with them. We continually, pay visit to them, and we just wait for a right time or right products to see how we can collaborate with those sovereign wealth funds as well. Yeah.
Okay. In terms of Saudi ETFs, though, could we see more of those coming too?
Yeah, I think definitely. We are doing research, small research. When we look at the market more deeply, we find out there's more interesting, sectors or asset classes will be interesting to our, regional investors. Yeah.
I want to pivot a little bit because this is the Capital Markets Forum for Hong Kong as well as Saudi. This Hong Kong market has been on fire, it seems, and really just going. Coming back into this bull market, you have multiple sort of ETFs that track not just the H-share but A-share market. Mm-hmm. What are you seeing in terms of flows right now?
Yeah, so obviously, this is the hardest market for this quarter globally. So very fortunately, we have world's largest Hang Seng Tech ETF, which is 3033. This specific ETF for this quarter is already up 25%.
Wow!
We see some profit taking from these specific products around like 150 million Hong Kong dollars. Taken profit. Redeemed from this product. But on the other hand, we also see another flagship floor, which is 2822. It's tracked Fuji A50 ETF.
Yeah.
We see very strong, inflow in that specific product as well. We see like it's more than 180 million inflow into that products. Yeah, for the past quarter. Yeah.
What does that tell you right now? Are people more bullish about this market? Because you have these inverse products
Yeah.
that also track these benchmarks. Are you seeing investors also betting on, or betting against, or betting for this rally more?
So it's a very good question. So for different investors, they have different views.
Yeah.
So for the past couple years, I think the main problem for the Hong Kong and mainland China markets, people don't have that much of the confidence or trust to this market. But right now we see, the major rally and also the confidence from some certain of the investors coming back. They're coming back, and we will definitely, welcome of this, because our majority of our AUM is based on A shares and also Hong Kong shares. But I think that behind these stories, there are main two drivers of this. First of all, is because of the recent macroeconomic data, they beat the expectation, and also there is another thing I think it's very important, and not a lot of people are talking about, is the new chairman of CSRC. Getting to the office.
Yes.
And he's doing something, it's very interesting. He's trying to clean the whole system, to improve the quality of listing company, and to encourage the listing company to pay more dividend. I think that will give us a new era of the investment into China and Hong Kong. It's an ongoing process, so we are still monitoring, and we try to bring interesting products to our clients as well.
You're definitely feeling that change right now. Before we go, I want to get your take on what's been going on with crypto. So CSOP decided not to launch a spot crypto ETF this time around. I mean, you missed out in the first round. It seems like, just given the lackluster performance we've seen so far in some of these ETFs that launched, are you feeling a bit vindicated? Are you happy with this decision right now?
Yeah, I would say, as industry participants, we always welcome new products, new ideas to the market. So unfortunately, at the first batch, CSOP, we cannot, introduce the physical spot Bitcoin, ETF on the market. But we are very glad there's 3 other peers introduced the products. And for us, the problem is we are still, closely working with our counterparties, our partners, try to do that, because to provide a successful ETF, it cannot only rely on fund managers. You still need custodians, market makers, PDs. Everybody will on the same page. So, but for us, unfortunately, a lot of our other counterparties are not ready yet. And by the way, we launched future-based Bitcoin ETF on 2022, which is performed very well. They track using futures to check the price changes. Yeah.
Is it a matter of if or when? I mean, is it just delayed right now? I mean, are you thinking maybe in a few months' time, or that you might actually launch one? Or?
But it depends on how ready we are.
Okay.
So CSP, we're prudent, and we know we have fiduciary duty need to fulfill.
Yeah.
If we were not ready, we were not ready. If we're ready, we will do it.
Chen, it's great to have you as always. Ding Chen. And that was the CSOP Asset Management CEO joining us here at the Capital Markets Forum at the Hong Kong Exchange. Haz, I'll send it back to you.
Yeah, she talks about prudence, not a bad thing. Yvonne Mann, great conversations. Thank you so much for that. Now, still ahead, Ernst & Young India shares their outlook on the renewable sector. Hear how the outcome of the elections could impact the industry's growth. That is next. Keep it here with us. This is Bloomberg. Welcome back. You're watching India Focus. Let's do a check on Indian markets. We're counting down, of course, to that India Open on a day when investors are pretty lackluster when it comes to the stock market. In fact, when it comes to India, it is the gauge of volatility, the VIX index that has risen in its longest streak, even underscoring growing uncertainty over the outcome of the nation's general elections as polling is into its final phase. While India is kicking off pretty much in line with the rest of the region under pressure, Sensex index down 0.2%. Nifty Bank index also under pressure there. Well, let's stay with India. India's political parties are betting big on renewables in their election manifestos. Prime Minister Modi, for instance, is promising to ensure energy independence by 2047 and to reduce petroleum imports. Let's discuss India's energy transition and renewable sector outlook with someone who has worked extensively on transactions in conventional as well as renewable power and infrastructure. Shrishti Ahuja is a partner at Ernst & Young India, joining us from New Delhi. Shrishti, good to have you with us. Now, when it comes to possibly a third term of Modi's government, I mean, what policies would help push renewables the right way?
Well, first of all, thank you for having me on the show, Haslinda. See, actually, what we've seen is that renewables by itself, just based on commercial merit, demands a lot of investment because it does today offer the lowest levelized cost of energy, or LCOE. And India today is the fourth largest renewable energy market, and just based on the contracted capacity, it will actually be the third largest market. So what we're seeing is that there is a lot of investment going into the sector. Decarbonization is a global mega trend for investment, and the government policies are actually kind of supporting that growth. So, whether it comes to the kind of benefits they're giving to long-term investors, or waiver of transmission charges, a concessional tax rate, increasing the allocation for renewable energy sector. So all of these augur well for the renewable energy market in India.
So having said that, Shrishti, how much of that renewable push in India is contingent on Modi's government getting re-elected?
See, what has happened is that, the Modi government has actually put up a machinery which is now fueling itself. So it is a bit like a nuclear reaction. Once you've set it in place, it is kind of propelling itself. So I would say that Indian renewable energy market is in that space. The other interesting thing is that, renewables today, is actually a much larger theme. So it is today energy transition. It covers, for example, green hydrogen, where India has set an ambition of being, one of the largest exporters globally, or whether it is, for example, biofuels, which encompasses the renewable natural gas, SAF, 2G ethanol. So all of these areas today, a lot of investment has gone in. We're starting off from a good base. So we feel that regardless of the outcome of the elections, the sector is in a good space.
Having said that, are there risks, though, to that renewable push if another government were to come into power?
See, there are 2-3 gating items, I would say. The first one being, evacuation. I think evacuation infrastructure today is the biggest bottleneck in setting up capacity on the ground. I think all the other factors are well taken care of. The government has planned a very large investment scheme into evacuation, but that remains one big bottleneck. I think the second bottleneck is probably the supply chain. So, for example, in India today, there's a manufacturing capacity of about 10 gigawatt of modules, another 30 gigawatt coming up. But most of this is mostly dependent on import of cells. So, that entire, supply chain, that could be the second constraint. And the third constraint could be availability of project finance, given the recent, RBI draft circular for provisioning, we could see some hiccups around that. But really, if these three aspects are addressed, the sector will be in a good position to attract more investment.
Shrishti, talk to us about the deals that you're seeing so far in terms of flows. Have you seen marquee deals, for instance, in recent months?
Yes, so a lot of deal activity, Haslinda, and there are various types of drivers. So on the supply side, for example, the homegrown platforms. While all of these platforms are already backed by very large investors, because there is a huge capacity coming online for bidding, for setting up, there is a constant need of capital. So that's one big driver on the supply side. When I come to, let's say, the international utilities who are very active in India, they have a constraint that they cannot consolidate too much of debt from an emerging market like India on their global balance sheet. So they are in the constant mode of setting up projects, monetizing them, and then setting up additional capacity. So I would say these are the two big drivers on the supply side. On the demand side, I think the sovereign wealth funds, pension funds are very active in India because renewables offer a good defensive asset class. The only missing piece over there is that the tariffs are not linked to inflation, so it does not offer a hedge to currency risk. But other than that, the asset class sticks for these long-term patient capital investors. And similarly for private asset managers, because they've raised a lot of capital for decarbonization. And the sector offers visible growth, which then is ripe for yield contraction and increasing returns. That's a second driver for demand of these deals. And given this kind of a supply and demand, we are seeing a lot of deal activity. Like in the last 3 years, about 100 deals have got consummated in the market. And what I'm also seeing is that there is a healthy competition on deals. So on each transaction there are multiple bids, but it's not too stiff that the investors become uncomfortable.
Recently, we had the RBI on its direction on project financing. I'm just wondering how that might impact renewables.
So it will definitely have a bearing, Haslinda. You're absolutely right. And what will happen is that if I try to convert this into what will be the impact on cost of borrowing, my assessment is that it will add about 50 to 100 bips to the cost of borrowing. What it will also do is it will make it more difficult for under construction projects to get financing because the provisioning norms have been increased. Similarly, because there is a minimum tail life now prescribed, refinancing, which is considered as par for the course for the sector, will become more difficult. But the good thing is that the government has set up these institutions like Power Finance Corporation, Renewable Energy Corporation, IREDA, which are specialized in renewable energy lending. So to a certain extent, the risks will be, the impact of this will be mitigated, but for sure it will have a bearing.
Shrishti, thank you so much for your insights today. Shrishti Ahuja, Ernst & Young, India. Plenty more ahead. Keep it here with us. This is Bloomberg. We are following. Nomura has joined JP Morgan in limiting dealings with Asian hedge fund giant Sagyanti, which is facing charges in Hong Kong of insider trading. Sources say Nomura won't add more leverage or new positions to its dealings with Sagyanti. The fund, its founder, Simon Sadler, and a former dealer say they will vigorously defend themselves against the charges. Holdings shares tumbled in late trading after the firm gave a lukewarm sales forecast for the fiscal year. The chip designer sees sales of $3.8 to $4.1 billion for the period, with analysts predicting sales of just over $4 billion. The forecast raises concerns the tech industry's AI spending spree might be slowing. And Intel is warning its second quarter sales will fall below the midpoint of its projections due to a new U.S. ban on chip exports to Huawei. The chip maker is maintaining its guided range of $12.5 to $13.5 billion. Intel still expects sales and earnings per share to grow this year. Sources say the U.S. revoked licenses allowing Huawei to buy chips from Intel and rival Qualcomm earlier this week. Now, let's take a look at markets and UK assets in particular as we count down to that BOE decision. It is set to stand pat, keeping rates at 5.25%. Traders looking for clues on whether Governor Bailey will start cutting rates at the next meetings in June and August after a dovish shift in tone. He faces a divided committee on when to actually cut rates. Well, that is it from Bloomberg Markets Asia. Horizons, Middle East and Africa is next. Keep it here with us. This is Bloomberg.